Okay, good afternoon to all the students here in the classroom and also the students that are at home. More or less 25, 30, I don't know if we get 30 here in classroom. And 38 at home, for the little by little increasing. I would like to start with a question, that is, do you have questions for me about the topics that we have discussed during Monday and Tuesday, the first two lectures? Yes, not yesterday, last Tuesday and this morning. You had the opportunity to discuss some exercises, and by tomorrow, okay, we will post also the exams of the last years, so that you can have an idea, but pay attention because, of course, in particular for the midterms, they are strictly linked to the topics discussed during classes. So the academic years are not always the same. Maybe one topic is more discussed during 1 year and less discussed during the following year. So pay attention to what we discuss here in class, but in this way you can have an idea of the type of exam. Do you have any questions? I would like to start. First, I need to share my screen. Okay. Then I would like to start with some examples of real financial statements about property, plant and equipment. This morning you had the opportunity to have a look at one of these notes of one of a real financial statements. But now I would like to discuss with you at least two financial statements regarding property, plant and equipment. Okay, and in particular this is E&I. I remind you that on Moodle you have the financial statements that I'm using during classes. So these 6 financial statements are all available on Moodle. This is E&I, and from page 187, from this page we have the consolidated financial statement. E&I starts with the balance sheet and property, plant and equipment. Okay? As you can see, for E&I, property, plant and equipment are very important. This is a message also for your project group. By this evening, because if I'm not wrong, last evening the timing for the enrollment for the group elapsed. So by this evening, we will publish for each group the name of the company. You have to download the financial statements. You have to analyze the consolidated financial statement, and you have to repeat the same analysis, the same discussion that we are doing here in classes. Okay? So the balance sheet, the income statement, the layout, the presence of intermediate results, and so on. And you have to understand for your particular company if the topic that we are discussing here in class is relevant or not. Okay? Since you have only 10 minutes in order to present the analysis, it is impossible to present everything. You have to choose the topics that are more relevant for your company or topics where you find notes, disclosures that are particularly interesting. I'm here and the same Professor Tonelli in order to answer to your questions about financial statements, but during these days, okay? The day before the deadline, Alberto and I, we will not answer to any questions, okay? Because you have all the time now during these days. If you don't understand something, for us it's not a problem if you come to us with the financial statements. Don't print it, it is enough on a pad or on the computer. And if something is not clear, we are here in order to answer to your questions. But not the day before the deadline, because it is not right. And one of the things that you have to do is, and this is very important also for your future job, you need to analyze and to spend your time on relevant matters. And so you need to understand if a particular topic is or isn't relevant, material, significant for that particular company. Look at E&I, property, plant and equipment. Almost 54 billion out of total asset of 109 billion. So more than 50% of the total asset is composed of property, plant and equipment. This means that for this type of company, property, plant and equipment are very, very, very important. E&I is an Italian company that operates in the oil and gas industry. So they need plant in order to refine, for all the refining activities. They need plant in order to extract oil. And so, as you can imagine, the amount of this plant is very, very important. In fact, 54 billion out of 109 billion of total assets. If we go, keep in mind that most of the financial statements, they present the financial documents, balance sheet, income statement, or other comprehensive income, cash flow statement, then statement of changes in equity, and then they start with the notes. Notes for the Italian companies are, generally speaking, presented with the first part, which is a narrative part, and then a second part with the breakdown of figures. If we go to page 204, here you can see the description of the accounting policy related to PPE, property, plant and equipment. Cost model, as I told you last Tuesday, even if in theory it is possible to choose between the cost model and the revaluation model, at the end, 99.9% of the companies use the cost model. So the cost model means that the initial recognition, the cost is the purchase price and the construction cost. This morning, you discussed some exercises where you were required to identify the initial amount to be disclosed in the balance sheet. Cost or purchase cost, construction cost, any costs that are directly attributable to the asset, and some other things. Then, for E&I, the present obligation, so the present value of cost estimated in order to dismantling, removing the asset, to restore the site, are very important in this industry. Okay? So there is also an indication about this type of cost that is discounted and recognized on the initial amount of the plant, property, or whatever. And as you discussed last Tuesday and probably also this morning, there is a provision recognized in the liability. Okay? Then there are informations about all the costs incurred after the initial recognition. This means that 2 years ago, E&I bought or constructed a plant. This year, E&I had to incur in some other expenses. For example, upgrading, revamping, reconversion of the plant. Keep in mind that this type of expenditure are capitalized if and only if it is possible to demonstrate that they generate an increase in the future benefits of the assets. On the contrary, the maintenance costs are immediately recognized in the income statement, because maintenance, think about the meaning of the word maintenance. This means that these costs they don't increase the productivity of the plant. They don't increase the useful life of the plant. They simply are necessary in order to maintain the productivity and the useful life of the plant as intended. Then there is an information about depreciation that begins when PPE are available for use. And then there is an important thing that I forgot to discuss last Tuesday. That is the component approach. The component approach is indicated in the slides. Component approach means that there is an asset, a very complex asset. So the company at the end buys a single asset. But looking at that asset, for example, an aircraft or a furnace or the other important plants, it is possible since the beginning to verify that within the single asset there are some parts with different useful life. In this case, IAS 16 states that it is mandatory for depreciation purposes to separate these parts, and in this way it is necessary to depreciate them according to their specific useful life. I'll give you an example. Suppose that a company buys an asset, very complex, like a plant. The plant is just one. The company has purchased the plant from a supplier. And suppose that the total cost is 1,000. Okay? But we know since the beginning that within this plant there are some parts that have a useful life of, suppose, 10 years. This means that after 10 years, it is necessary to intervene, and so the company has to substitute those parts. All the other parts, they have a useful life of, suppose, 20 years. Okay? So the plant is a complex asset. It is possible to identify within the plant two parts. Suppose the part A and the part B. Suppose an aircraft, it is not the same, the useful life of the engine, for example, compared to the furniture that are inside the aircraft. And for the plant is the same, for complex plant, of course. And suppose that for a part estimated for a cost of 800, the useful life is 20 years. And for the remaining part, 200, the useful life is 10 years. So it is a mistake to depreciate 1,000 over 20 years or 1,000 over 10 years. This is a mistake because it is necessary to take into account the so-called component approach. Component approach means that even if the asset is a single asset, bought with a single invoice, this doesn't matter. For accounting purposes, the depreciation is computed having regard to the single components. So now I have a question for you. Suppose that the land was acquired and it is available for use from 1st of January, year 1. Okay? Just not to complicate too much the example. So from year 1, 1st of January, the plant is available for use. This means that we need to start with depreciation. Do you agree? So, how much is the depreciation to be recognized for year 1? A colleague of yours in the chart wrote that for the part A, the annual depreciation is 800 divided by 20 years, and so 40. For the part B is 200 divided by 10 years, and so 20. So this means that the depreciation recognized in year 1 is equal to 60. Do you agree? This is clear for everybody? If you want, you can write depreciation of part A 40, depreciation of part B 20. Or if you prefer, depreciation 60. What is important is the way the amount of depreciation is computed. Is this clear for everybody? I have another question now for you. Take into account this information, okay? This information. Now my question is the following. Now we are at the end of year 10. At the end of year 10. my question is about the amount that you expect to find in the balance sheet in the property, plant, and equipment in the asset side at the end of year 10, of course, after the recognition of the depreciation for year 10. Take into account that this is the information about this plant. How much is the amount of the property, plant, and equipment in the balance sheet at the end of year 10? There are some answers in the chart. Very good. I'm looking at the students here in the classroom. Do you agree with the answers? Yes, because of course this means that at the end of year 10 the part B is completely depreciated. We are in the half of the useful life of the part A. So this means that the amount is 400. Okay? You can identify the amount in different ways. Some of your colleagues, like Shruti and Sarah, they started from the historical cost, 1,000, and then they deducted the accumulated depreciation for both part A and part B, 600. Or you take into account that the only part that we have is the part A. But if our estimate is confirmed, this means that at the end of the year 10, the part B, if it is completely depreciated, this means that the company needs to replace the part B. Do you agree? The company needs to substitute the part B. So this means that at the beginning, or at the end of year, or at the end of year 10, or at the beginning of year 11, the company has to replace the part B. So replacement of part B. We don't know if the cost for the replacement is exactly 200. It could be 180 or 210. We don't know. Suppose that the cost of the new part B is equal to, suppose, 180. Okay? So now, please compute again the depreciation for year 11. What about the students here in the classroom? Do you agree with your colleagues? For the part A, we continue with the depreciation of 40. The part B is now replaced. The new cost is 180. And if there are no changes in the estimate of the useful life, the part B has a useful life of 10 years, and so 18. Okay? So the depreciation for year 11 is 58. that is the original 40 plus the new cost divided by the 10 years remaining. This is the new amount of the accumulated depreciation. So I have again the same question that I made some minutes ago. That is the amount to be shown in the balance sheet at the end of year 11. How much is the amount of property, plant and equipment at the end of year 11? All the doors are open and so it's quite easy. There are different ways of computing it. Viola suggests us to start from the amount at the end of year 10. Then we need to not only to decrease for the depreciation of the year, but we need to increase for the new investment that the company has done, 150 minus the depreciation for the period. Okay? So 522. Why? Because this is equal to the net carrying amount at the end of year 10, but plus the new investment, that is 180, minus the depreciation. Okay, is this clear? The component approach is mandatory under IAS 16. Again, as you can imagine, this is very important in some industries, in some sectors, not significant in others. It depends on the type of assets of the company. Okay? Is this clear for everybody? Any questions? I saved the file. Okay. So that this evening I can upload it. And we can move again to E&I. Okay? This is the component approach. Land is not depreciated. And then, for example, here there are some indications about the replacement cost. Please read here. Expenditures for ordinary maintenance and repairs are recognized as an expense as incurred. Okay? And then the derecognition. The derecognition is when there is when the PPE is disposed of, for example, because of a sale, or when it is not possible to obtain any future benefits, and so even if it is not sold, it is no longer used. And the gains and losses recognized in the profit and loss, of course, of the year when the sale occurs. I suggest you to read this part because, as you can see, it's a summary. It's a recap of the most important concept of IAS 16. the standard about property, plant, and equipment. If we want to read, to know something more about property, plant, and equipment, we need to go to the notes 11, where there is the breakdown. Pay attention. The layout of these tables, of this chart, is not mandatory. So at the end, the information provided is always the same, but there are many different ways of providing the information. And at the exam, we could make a copy and paste of part of a chart of PPE of a company, and then we can ask you some things, some aspects. For example, look at the chart. Okay? This is the chart of E&I. Okay. Land, buildings, the wares, plant, machinery, and other different tangible assets. Look at the total, okay? What is relevant for me now is the total. So I can ask you, for example, I can give you this chart at the exam, and I can ask you how much is the depreciation recognized in the income statement in 2020. How much is? My suggestion is always to focus on the important, relevant, significant things. How much is? Probably there are some answers in the chart. Yes, exactly. Okay. Depreciation. Okay. This is the depreciation recognized in the income statement as a cost. Another question: how much is the amount shown in the balance sheet at the end of 2020 of property, plant, and equipment? How much is? We saw it some minutes ago when we analyzed the balance sheet, but you can see it here. Okay? The net carrying amount. The net carrying amount is the difference between the gross carrying amount, historical cost, minus the accumulated depreciation. Unfortunately for you, E&I, instead of using the word accumulated depreciation, E&I uses provisions for depreciation and impairment, but it's the same. Okay? So 184 billion is the historical cost, minus 130 billions of depreciation and impairment losses. But this is the accumulated depreciation and impairment losses. Right now, you don't know exactly how to determine an impairment loss, but it's simply a reduction in the value of the property, plant, and equipment. So part of the value that is not recoverable. But in a few days, we will discuss the impairment test. Is this clear for everybody? It's possible to present, I repeat again, many different ways. Another information is this one. 4.4 billion additions. Additions means, what does addition mean? Give me another word for addition. Sorry? I didn't catch.
Replacement.
Yes, replacement or new investment. Okay, so these are new plans, in particular, new tangible assets in progress. Here, as you can see, 3 billion of tangible asset in progress. Okay, purchases like as your colleague, or internal construction, but new investments. I can ask you, what is the meaning of asset in progress? And I could ask you also why. It's not so easy, of course, but why? For asset in progress, the depreciation is 0. Why? Someone in the classroom, please. Yes, thank you.
It starts when they're available for use.
The depreciation starts only when the asset is available for use. These are tangible assets under construction, so they are not yet ready for the use. So they are tangible assets, but the depreciation is not there because they are not available for use. So look at the chart. Look at this row. Transfers. Okay? Look. This item is the most moved. There are a lot of changements in this item. And it makes sense. Because if an asset is under construction, there are new assets under construction for 3.1 billion. But in the meantime, part of the assets that were under construction at the end of the previous year now are finished. And when the asset is completed, the asset is moved to the specific category. Look at the sign. Transfers minus 2.6 in the asset under progress, moved to what? Mainly exploration and production wells, plant and machinery. Is this clear? Look at the transfers. Look at the total. It's 0. Because transfer means that the asset was under construction, now is a plant, so it's just a movement from an item to another. Is this clear for everybody? So what I would like that you were able to do at the end of this course is to read financial statements and to understand the different movements of the items, to understand the meaning, to understand the effect of the decision of the company. And the only way in order to obtain this goal is to understand how the accounting works through exercises, but also by reading real financial statements. And this is why at the exam, for sure, there will be 2 or 3 parts of real financial statements with some specific questions. Nothing difficult, exactly the same things that we are discussing here. Viola, the amount is equal to 0 transfer, okay? Because it's the item transfers simply mean that an asset that was under construction now is completed, and so this part is then transferred to the plant of machinery or of the exploration and production sector, or other plant of machinery, or to land and buildings. So there are only movements, but always between tangible assets, are only changes from an item to another, but always within property, plant, and equipment. So at the end, the property, plant, and equipment, the total, doesn't change, because at the end, they are always property and plant, in the property and plant items. But last year, in the category under construction, in progress. This year, in land or machinery or plant or whatever. Is it clearer now, Viola? Okay. And for all the other students, any questions? Okay. Then, just here there is a sentence. Capital expenditure. Do you know the meaning of capital expenditure? Investments. I'm sorry again, but there are many ways, many words in order to identify at the end the same things. Okay? Look. In the chart, additions. Additions means investments. Another way is capital expenditure. Different words, same meaning. Capital expenditure, addition, if the addition are the addition of property, plant, and equipment, or purchases, new investment, the same. Okay? Look, here there is a sentence about capitalized finance expenses. If we go back to the slide, and in particular, the slide number 18, borrowing cost. This is a very particular situation. Borrowing costs are interest and other expenses linked to borrowings. Okay? Interest expense or borrowing cost is the same. The general principle is that borrowing costs are recognized in the income statement, in the profit and loss, when incurred. By the end of the course, we will analyze also how to compute this interest expense according to IFRS. But generally speaking, if you obtain money from a bank, you have to pay an interest. The interest expense is recognized in profit and loss. Unless there is an exception, unless borrowing costs that are attributable to the acquisition, construction, or production of the so-called qualifying asset. An asset is a qualifying asset when it takes a substantial period of time to get ready for its intended use or sale. Okay? So this means that if we start today the construction of a very complex plant that takes, for example, 3 years of construction, we need to finance the construction of this plant. So we pay borrowing costs. But unfortunately, during the construction, the plant is not able to generate revenues. Do you agree? Because under construction, there are no revenues, no profit from that plant. So under IFRS, if the construction of an asset takes a substantial period of time, what does mean? What does this mean? Substantial period of time. Any idea?
More than 12 months?
For example, but do you remember the first lecture when I told you that IFRS are principle-based, okay? Substantial period of time. Then, more or less, for all the companies, substantial period of time means more than 12 months. So if the construction of a plant requires more than 12 months, the borrowing costs are capitalized as part of the cost of the asset. Why? Because the qualifying asset is not generating benefit. We need to wait for the end of the construction. So these borrowing costs are eliminated from the income statement and recognized as part of the asset. Is this clear for everybody? Under IFRS, this is mandatory when the period of time necessary in order to construct or in order to sell the asset is substantial. So, if we go back to E&I, now we can read again this sentence. Okay? Capital expenditure included capitalized finance expenses. Why? Because E&I is constructing plan for which the production period, the construction period, is estimated to be longer than 1 year. What is the amount of this interest expense included in this 4.4 billion of addition? Is 73 million in 2020 for the exploration segment and and total 73 million, of which 51 for the exploration segment. What about the interest rate used for the capitalization? The interest rate used for the capitalization is, in the case of E&I, 1.3% up to 2.2%. Okay? This is significant for E&I. Is a non-material aspect for other companies. Right? Because if you buy a building that is already available for use, capitalized interest expenses, 0. Because the construction period doesn't exist. The building is there, already available. Is this clear for everybody? Okay. So this is just an example. I suggest you to have a look also to the other financial statements, so that something is not clear, you can ask for an help. Only one thing here. This item, currency translation differences. Do you remember last Tuesday when we discussed the other comprehensive income? I told you that the most important other comprehensive income is related to foreign currency differences arising from the translation of financial statements of subsidiaries that prepare their financial statements in the currency other than euro. So when we read here 53.9 billion euros, this is the sum of assets, to be more precise, property, plant and equipment, of E&I and all of its subsidiaries. But some subsidiaries of E&I don't use the euro. They use other currencies. And from the beginning of the period to the end of the period, the foreign exchange, the exchange rate can change. And so the amount of property and plant and equipment is reduced of 4.1 billion, not because of sales, not because of depreciation, but simply because the translation of subsidiaries that use currencies other than euro. If we look at the previous year, look at the effect, positive. Could you see it? Positive. Because the exchange rates, euros against US dollars or other currencies, the fluctuations are big fluctuations. Okay? And for E&I, look, more or less in 2020, this movement is almost, not exactly 10%, but 8-9% out of the total amount of the property, plant and equipment. Is this clear? Any questions? Question from students that are at home? It's like, okay. Okay. If everything is clear, I would like only to highlight a very small aspect about a very particular situation. Government grants and assistance. The slide is at slide number 15. It's after IAS 16 and before borrowing cost. Okay, few slides. But just to highlight an important thing. It is possible for companies to receive government grants in order to support the company. Okay? For a lot of reasons. In the past, for example, in the past I mean before the pandemic, in order to push companies, for example, to invest in some specific area. For example, in Italy, I think that you know also the foreign students that the south of Italy is less, there are less companies. So in the past, the Italian government, in order to push companies to invest in the south of Italy, for example, granted the companies some money, but with the obligation to construct, plant, or to establish companies in some specific areas. Okay? So, during the pandemic, many governments decided to assist companies in order to help, in particular, companies that were obliged to face difficulties due to the pandemic. Generally speaking, the IFRS, but it's exactly the same more or less all over the world, government grants are recognized in the financial statements only where it's reasonable sure that the entity will comply with the conditions related to the grant, and the grant will be received. Okay? This is very important because, generally speaking, in order to obtain this grant, it is necessary to apply. So it is necessary to make an application, then it is necessary to wait for some months. And then, if you satisfy the requirements and if there is enough money, you receive the grant. So it is not possible to recognize in the balance in the financial statements the grant when you make the application. It's too early, because simply making the application doesn't mean that you will receive the grant. Okay? So the company has to wait for the reasonable assurance that the conditions will be satisfied and the grants will be received. At the end, I can assure you that companies wait for the time of collecting the grants, because before collecting the grant, it is not so easy to demonstrate the reasonable assurance of obtaining the grant. Is this clear? Is this clear for everybody? Then, once the grant is obtained, there is a very, very simple principle. It is necessary to match the grant towards the cost for which they are intended that they intend to compensate. For example, if during 2020 the company A receives money because of the pandemic, that money, that grant, must be recognized as an income in 2020. Why? Because the objective of that grant is to compensate the company for losses of 2020. Is this clear for everybody? But now I'll give you another example. Suppose that you receive a grant, but with a specific purpose. You are obliged to construct a plant with a useful life of 20 years. So suppose that you receive the grant today in 2021, and just for our case, just to simplify it, suppose that the plant is available for the use starting from 2021. Okay? So you incurred in 1,000 costs in order to construct the plant. And you obtained, for example, 300, I don't know, euros, thousand or whatever, of grant. But this grant is strictly related to the plant. And the useful life is 20 years. So, your opinion. What is the accounting for the grant? Is it right to recognize the grant as a revenue for 300 in 2021? Is it the right approach or not, in your opinion? Yes or no? You have to speak louder. Otherwise, I can change strategy. Sorry for the students that are at home. Oh, very good. In this way, I can listen. Do you agree? Do you think? What do you think? So, if the company obtains a grant of 300, but this grant is related to the acquisition of the plant. The plant has a useful life of 20 years. Is it right or not, in your opinion, to recognize the grant of 300 in the income statement of 2021? No. Why? Thank you very much for answering.
Because you should divide it over the useful life of the plant.
Exactly, because the principle is always the same. If there is a grant from the government or another public body, the grant is for something. Okay? And so you need to relate the grant to the purpose. And if the purpose is in order to push the company to invest in the plant, since the costs of the plant are recognized over 20 years as depreciation, the same for the grant, because the grant is related to the plant. So this 300 is not recognized as a revenue in 2021, but it is divided over 20 years because it must be related to the useful life of the plant. Because the cost of the plant is recognized in the income statement according to the useful life. Is this clear? If you understand this concept, then you can account for any type of grant. Because the solution is always the same. It depends on the reasons for obtaining the grant. When the grant is for property, plant and equipment, or generally speaking, assets like tangible and intangible, the grant must be divided over the same useful life of the assets. Is this clear for everybody? Any questions? Okay. I hope everything is clear. We will have the opportunity to verify it with the exercises. Now, if you don't have questions, oh no, sorry. There was not intangible asset, but investment properties. The last tangible asset before moving to intangible. Investment properties. Investment properties. Keep in mind that property is land or buildings. Property. Okay? Property in English means land or building. Investment property, as I told you last Monday, is land or building or both land and building held in order to earn rentals or for capital appreciation or for both. But for sure, they are not used for the production, they are not used for the administrative headquarters, for example. They are not used as showrooms in one word. They are not used by the owner. They are rented to other companies, or they are held waiting for an increase in the prices of the property. More often, the goal of the company is to obtain both. I mean, I rent the property, and in the meantime, I wait for an increase in the price of the property in order to obtain a gain. Is this clear for everybody? Investment property. No particular issues about initial recognition and initial measurement. It's exactly as all the other properties, plant, equipment, and so on. The peculiarity is about the subsequent measurement. Because the subsequent measurement can be done using either the cost model or the fair value model. Last Tuesday, I told you that the revaluation model for property, plant, and equipment is not used. The fair value model for investment property is used. Because in this case, this property, this land, these buildings are not used by the company. Okay? They are rented. So they are more similar to a financial investment than to a plant or a property that is used as the headquarters of the company. Because an investment property is not used by the company. It's an investment of money. Rentals are generated by this property, and think about this type of property. They can be sold anytime because they are not used by the company. If I have a very beautiful building, but this building is used for the headquarters of the company, even if its fair value is very high, I cannot sell it because it is used for the headquarters of the company. On the contrary, if the building is rented, if the market value is very high compared to the original cost, I can sell it and I can monetize the gain. Is this clear? It's completely different having a property used by the company in the production activity for administrative purposes, for the shops, or having a building that is rented. So the fair value model is used in particular in Europe, in Spain, and in Germany. In Italy it's not so used, but in Germany and in Germany and in Spain is a model that is chosen by a lot of companies that, of course, if they have investment property. Look at the two models. Cost model, I don't say anything more because it's exactly the same model as for property, plant, and equipment. For the fair value model, the mechanism is completely different. Completely different. At the end of each reporting period, the property is adjusted according to its fair value. Decrease and increase in fair value are immediately recognized in the profit and loss. No depreciation charge. So it's a completely different accounting policy. The objective is to show the fair value of this property in the balance sheet. Think for 1 second, if you are an investor of a company that has a huge amount of investment property. You are interested not in the cost, historical cost, but you are interested in the fair value of the investment property. Do you agree with me? Some example. First of all, with the case, an exercise. Suppose a company A, suppose that on January the 1st, year 1, company A buys an investment property, or to be more precise, a building that is used as an investment property. IP stands for investment property. Cost, suppose 1 million. Okay. Since it is an investment property, okay, this means that the company has to apply the IAS 40, that is the standard that states what we have just discussed. Okay? So the company can choose between two different models. The cost model, or fair value model. Okay? If the cost model is chosen, the company has to estimate the useful life, suppose 40 years. Okay? So this means that if the residual value is 0. Each year, the company has to depreciate the cost, historical cost. Okay? So we have an annual depreciation of 1 million divided by 40 years. So an annual depreciation of 25,000 euros. Do you agree? So this means that if this is the balance sheet, at the end of year 1, 2, 3, 4, for example, okay, how much is the amount of the investment property in the balance sheet? IP stands for investment property. Okay. At the end of year 1, how much is the amount of the investment property at the end of year 1? How much is? $975,000, because we need to recognize the depreciation in the income statement, and the depreciation is 25,000. So the initial amount was 1 million minus 25,000. This is the amount at the end of year 1. If everything remains equal, in year 2 another 25,000 of depreciation. So this means that the amount of the investment property is 950. Do you agree? Yes. The same in year 3. And then in year 4. So if the cost model is applied, it's the same. Okay? Exactly the same. But now, look at what happens if the fair value model is applied. Do you remember the definition of fair value? Do you remember the definition of fair value? I'm not interested exactly in the same words of the definition, but in the concept.
Maybe the value that I found from the market.
It's a market value, okay? That's true. But in the market, you can have both the value for who intends to sell and value in order to buy. Okay? The fair value, if I have an asset in my balance sheet, is the amount that I can obtain from the sale. Okay? So, if the fair value is used as the model, first we need to determine the fair value. Okay? And in your opinion, for an investment property, the fair value of an investment property means a building, a shopping mall, for example, is determined the fair value of the fair value of a shopping mall and a building determined according to level 1, level 2, or level 3? Because yes, that's the there is the market for the buildings, but you cannot go to a website and you cannot see exactly the price of that specific building. You need to use valuation techniques in order to determine the market value of the building. And since each building is different compared to another building, in most of the cases, the inputs are not observable in the market. And so it's a level 3. Okay? So you need to determine the fair value. More or less the market value. It's not exactly the same, but so we need to determine the fair value at the end of year 1, at the end of year 2, at the end of year 3 and 4. Okay? And suppose that at the end of year 1 is 1,010,000. At the end of year 2 is 1,100,000. Probably too many zero. No, okay. Then 1,200,000. And then suppose 1,150,000. Okay? I repeat again. In order these amounts, the fair value, that is the amount that the company would receive if impairment property is sold, okay, is the result of an estimate. In most of the cases, level 3. If we go back to the slide, okay, look, fair value model. Is the depreciation charged? No. The investment property must be shown in the balance sheet at its fair value. Any change in the fair value is immediately recognized in the profit and loss. So, go back now to the exercise. And we need to try to prepare the balance sheet and the income statement. First, depreciation, 0. Okay? Because if the fair value model is used, the depreciation is not charged. What about the investment property? Fair value is the subsequent measurement. So this means that at the end of year 1, investment property is recognized at 1,010,000 euros. But how much was the cost? 1 million. So this means that at the beginning, the investment property is recognized at 1 million. Now, at the end of the reporting period, we want to read 1,010,000. So there is a change in fair value of the investment property that for year 1 is a gain of 10,000. Do you agree? Second year, how much is the fair value? 1,100,000. Compared to the previous year, this means that there is a gain of 90,000. Year 3, fair value is 1,200,000. So this means that there is a gain of 100,000. Look at year 4. The fair value now is decreasing. So there is a loss of 50,000 in the income statement. Is this clear for everybody? Two model, cost model, fair value model. It's up to the company to choose. Of course, you cannot change idea each year. Okay? Generally, according to the board, the best criteria is the fair value model. The best model for the board is the fair value model. Are there any questions for the last part of the class? If something is not clear, please ask. The girl with the pink mask. You were, I realized that you were discussing the exercise, and if something is not clear, I'm here.
So the first,
Okay. You have only, I ask you only to speak.
Okay, so the first value, the 10,000, is given by the 1 million investment minus the value. And then what about the
I suggest you just to invert the terms. Is the difference between the fair value and the initial investment.
that's
Okay?
okay.
But that's right.
And what about the others value? Like how you
At the beginning, the first year, you have the investment and the fair value at the end of the reporting period. For the second year, in your accounts, at the beginning of the period, you had 1,010,000. Then you need to adjust 1,010,000 in order to obtain 1,100,000. So the increase is 90,000. Then again, the amount at the end of the second year is the amount of the beginning of the third year. And if we want to obtain 1,200,000, we need to increase of 100, and we have a gain. But for the last year, since there is a decrease in the fair value, we need to decrease the amount, and we have a loss of 50,000. Okay? Thank you for your question, because at the end, in most of the cases, the question of one student is at least the question of other 20-30 students. So you please make questions, a lot of questions. Okay? Here in the classroom and also from home. Fair value model for the board is the best criteria. But for many reasons, they decided not to oblige the companies to use the fair value model, but to leave the companies free to choose. But there is a but. But since according to the board, the best criterion is the fair value model, if the company decides to use the cost model, the company is obliged to disclose the fair value in the note. Is this clear for everybody? So, since the fair value is considered to be the best criterion because these are investment property. If you choose the cost model, you can. It's an option that you have. But since the investors, the shareholders, the lenders, the creditors are interested in the fair value of the investment property, if you use the cost model, in the notes, you must disclose the fair value of the investment property.
Which is the difference between the fair value model and the impairment test?
Good question. The fair value model, you do not need the impairment test because you adjust the amount in the balance sheet at the end of each reporting period according to the fluctuations. Increase in fair value, decrease in fair value. The impairment test is used for when, the cost model, and this is not only for investment property, but also for property, plant, and equipment. Okay? It's the same. The impairment test is the test in order to verify if the cost, or better, if the net carrying amount, cost minus accumulated depreciation, is still recoverable. So, the impairment test, the objective is to reduce the amount in the balance sheet, never to increase the amount over the cost. So the impairment test, the goal is to verify if the cost, to be more precise, the net carrying amount is still recoverable. If not, you need to decrease the amount. But you cannot increase the amount over the initial cost. This is the difference. So in the fair value model, okay, here, you always adjust the amount in the balance sheet according to the changes in fair value. Up and down, up and down. Of course, they fall always up, but sometimes they both fall down. Okay? The fair value model was chosen by a lot of Spanish companies in 2005, when for the first time the European companies were obliged to use the IFRS. Why? Because in Spain, the real estate market was growing, in particular for all the investments in the islands, like in Baleares and so on. So the idea was, I choose the fair value. In this way, year after year, I can show in the balance sheet the value of the property, and in the meantime, in the income statement, I have a lot of gains. But financial crisis of 2008 and 2009, a huge drop in the real estate markets. The fair value is a beautiful criteria, but when there is a drop in the market prices, you need simply to accept it, and so to adjust, adjust the amount of investment property. You have to recognize huge losses in your income statement. The impairment test is different because its goal is different, just to verify if the carrying amount is still recoverable. And in probably tomorrow afternoon, or at least Monday morning, we will discuss it in details. I would like to show you, for example, Ocean. Page 97. This is the consolidated financial statements of Ocean, French company. I think that you know Ocean. Look here. Investment property. We don't find investment property in E&I financial statements, balance sheet, or in the other companies because they are not significant. For Auchan, they are. Look, this is Carrefour. And page 247, statement of financial position. I need to okay, this is Carrefour. Look again. If I keep investment property, not the same amount, not the same relevance, but again clearly disclosed. Okay? For Auchan, they are more material because the total asset is 23 billion, of which 3.9 billion of investment property. And if we go to page 130, we can read the accounting policy and in particular shopping malls, retail parks and undeveloped lands are recognized as investment property but based on the cost model. Okay? So cost model means, as we have just seen, that the investment property is recognized at its initial cost less accumulated depreciation and impairment loss. Okay? But as I told you, even if the company uses Auchan uses the cost model, but according to the standard, it is necessary to disclose the fair value. And Auchan has put in place a process, evaluation process, in order to estimate the fair value. Level 3, as I told you before, okay? There are two independent real estate experts. So the fair value is not determined internally, but with the help of two external experts in order to evaluate the fair value of this investment property. And it is based on a discounted cash flow model based on 10 years cash flows for shopping malls and retail parks, and based another model for the undeveloped land. If we go here, we can see a chart with the gross amount, the depreciation, and the net carrying amount. For 2020, here you can see the amount presented in the balance sheet, 3.9 billion. Okay? Here we know that this investment property have generated an income, rental income, for 498 million. Read the numbers for the previous year. 2020, 9 months out of 12, more or less, affected by pandemic. So the rental obtained were not similar to the previous year because of concessions allowed by Auchan to the tenants. And the cost 431 million. The particular situation, as you can see, that even if the rental during 2020 were lower compared to the rental of 2019, the cost of 2020 were higher. Okay? 431 million compared to 410 million because of sanification and so on. Information about the fair value. The fair value is 7.5 billion, whereas in the balance sheet, these investment properties are disclosed at 3.9 billion. You see? So this means that if we read these financial statements, we can immediately know that Auchan has a lot of investment properties accounted for using the cost model. But the market value is more or less 3.5 billion higher, greater than the carrying amount of that investment property because of this difference. Is this clear for everybody? Of course, in the E&I financial statements, this information is not present because investment properties are not relevant, are not significant. For Auchan, they are. The same for Carrefour. In fact, you can find more or less the same information for Carrefour, even if for Carrefour are less significant compared to Auchan. Is this clear for everybody? I think that you are waiting for a break. 20 minutes and then we start again. Hai lasciato?
10 minuti per calcolare la provvision, gli interessi, le 4, io l'ho fatto solamente la 1, 2, poi c'è il